Hello, this is Professor Marsh, and this is Principles of Financial Accounting, ACC 210-0 online in spring of 2022, Newberry College, and this is Chapter 2, Unit 2 in our course this semester. I'm going to give you the big picture first. With respect to bookkeeping and accounting. And for the next 5 weeks, this is the week of February 7th through the 11th. So beginning this week, we're going to look at the typical financial statements and how to construct them. And so this part of the course is going to give you the nuts and bolts of bookkeeping and accounting. When we get to the midterm in, I guess, week 7, you're going to be able to say, if you have studied diligently, that you understand the bookkeeping and accounting process, maybe not all of the special entries that we'll get into in the second half of the semester, but as far as basic bookkeeping and accounting, you should be competent in your understanding of the tools and techniques that we use for bookkeeping and accounting, and also how to construct the basic 4 financial statements that we use. So we'll dive into the first 2 learning objectives in Chapter 2 now. And we'll be looking at the typical financial statements from the 30,000 foot level. Then we will just skim the third objective and spend weeks 3 through 5 learning how the numbers get entered into the financial system and put onto the respective statements. And in week number 6, we will revisit Chapter 2 and take a deep dive into Section 2.3 with some exercises constructing those financial statements. So we'll put together some of our own financial statements, and so when you talk to prospective employers in the future, you can say that you have actually prepared financial statements, hopefully in accordance with GAAP. We'll see. We'll have to grade them, but that will be something that you can at least take to an interview for a job if you want to do something, other than the typical student summer jobs and part-time jobs. So, okay, let's go ahead. So our learning objectives for Chapter 2, the first one is to describe the income statement, the statement of owner's equity, the balance sheet, and statement of cash flows, and how they interrelate. So we will learn that. We will define, explain, and provide examples of current and non-current assets, current and non-current liabilities. So we have a distinction in accounting between short-term and long-term, and we call the short-term current, and the long-term, the book calls them non-current, which is the correct usage. I sometimes slip and call them long-term assets and liabilities, so anyhow, we're going to learn about that. And the basic rule, you can remember it right now, is just anything that's going to happen within a year is current, and anything that's going to happen that could take longer than a year is non-current. And then we'll also look at equity, revenues, and expenses, and how those are entered into the financial statements. And then the third objective that we're just going to skim, 2.3, is to prepare an income statement, a statement of owner's equity, and a balance sheet. But I want to save that until after we learn, kind of the nuts and bolts of the bookkeeping entries, and you're familiarized with, really what this all means. So take a look at it, skim it. We'll probably have a question or two about it during this unit, but just understand that as far as the exercises to construct the financial statements, we're going to save that for week number 6. Chapter 2 is going to have a weekly quiz, just as Chapter 1 did. I will post that on Friday. There's also going to be some homework problems, which I will post sooner, probably sometime later today. Today is actually Tuesday the 8th, as I'm recording this. And the homework problems will be to submit in Wolf Den probably around the same time that your quizzes do. Homework problems are what the CPA exam calls simulations. Or if you see or hear that term, it just means a problem or exercise. That's a simulation on the CPA exam. And it's going to be your typical homework assignment, the same type of things that you might see on the CPA exam if you take that exam, or perhaps something similar to the problems you might get asked if you're working in accounting or bookkeeping in business. The chapter begins with a description of types of business structures: the sole proprietorship, the partnership, and the corporation. And I'm going to add one of those to the materials, and that is the limited liability company, sometimes called the LLC. The LLC is a hybrid entity, and the accounting and taxes reporting, the tax reporting and the accounting for an LLC can be either a sole proprietorship if it only has one member who owns 100% of the LLC and it is treated as a disregarded entity for tax purposes, or it can be a partnership. That's the default classification for an LLC that has more than one member. Or it can be a corporation if the LLC makes a special election, sometimes called the check the box election, to be treated as a corporation for tax purposes. So an LLC is a hybrid, but the types of business structures that the book will talk about are sole proprietorship, partnership, and corporation. Okay, so first objective, describe the income statement, statement of owner's equity, balance sheet, statement of cash flows, those four financial statements. This is part one. So financial statements provide financial information to stakeholders to help them in making decisions. And there are four financial statements, and we've gone through that several times. The questions that these statements answer can be if you look at the gearhead example that's in your book at section 2.1, what are our revenues and expenses? What are our profits? What's our cash flow? Do we have money to spend? Inventory. How much do we need to keep on hand in order to, support our sales levels? Accounting and the four basic financial statements, they provide this information for stakeholders. Who are the stakeholders? Well, you've got the manager, also the lenders who might lend them the money to expand, perhaps the employees who need to purchase the inventory and avoid the empty shelves, and the complete set of financial statements is described by the book as like an X-ray of the company's financial health. So it's a diagnostic tool that can be used just as a physician uses an X-ray to diagnose illnesses, injuries, and that sort of thing. Note the ethical item regarding utilitarianism that's in your chapter. I taught business ethics last semester, and utilitarianism is an ethical theory about maximizing the greatest good for the greatest numbers. That's the touchstone for utilitarianism. But it doesn't just mean maximizing this quarter's profits or cash flow. Consider the long run in creating the greatest good for the greatest number of stakeholders, and that's really something that has to be considered and balanced. It's not just this quarter, this year's results. It's how do we build something that will be sustainable in the long run. Uh, See the simple income statement for Chris's Landscaping for the month, the period. Uh, Income statements are for a period. Balance sheets are typically as of a certain date. For the month, the period August 2020. Revenue is listed first, and then expenses are listed by category, and they're totaled into total expenses, and net income is total revenue minus total expenses, or $1,400 minus 1150 equals 250 as net income. So if you put that together, you've just done your first simulation. Okay, so that's Chris's Landscaping. That's your first simulation. That's a simulated income statement. If expenses exceed revenue, then we would have a net loss. And note that purchases and sales of ancillary assets are sometimes called capital assets, can create gains or losses. So if expenses exceed revenue, then we have a net loss. But we also use the term loss and gain to refer to the profit or the absence of a profit on the sale of an ancillary or capital asset. Okay, so the book notes that the statement of owner's equity shows the net worth of shows how the net worth of the organization changes for a period of time. So the statement of owner's equity is a balance sheet item. It's a balance sheet account. But the statement of owner's equity shows how that balance sheet account changes for a period of time. So it's kind of a hybrid financial statement. It's talking about a balance sheet account, but it's showing how it changes during a period, not as of a certain date. So in addition to showing net income or net loss, the statement of owner's equity also shows investments by and distributions to owners. So you have a statement of owner's equity, pretend it's beginning balance, zero contributions and distributions, zero beginning balance. You have $250 of net income for Chris's Landscaping for August of 2020. And so the ending balance in owner's equity is $250 at the end of the month. So it increased by $250 during that period, and it all was internally generated from profits of the business. Now, the balance sheet shows the organization's financial position on a given date. The balance sheet lists assets, liabilities, and owner's equity. And the accounting equation, assets equals liabilities plus owner's equity, is something you're going to see over and over and over again this semester until you memorize it and then are sick of it. So in any event, A equals L plus OE, assets equal liabilities plus owner's equity. Learn it, love it, live by it. This is double entry accounting, and these are the debits and credits. Assets are always debits, liabilities and owner's equity are always credits. So debits and credits. The statement of cash flow. So liabilities. Let me talk about short-term and long-term. So liabilities. There are short-term liabilities. Those are to be paid within 1 year of the date of the balance sheet, and often these are to creditors, as the book defines them. Creditors. They could be things like accounts payable. So you order some more inventory from your wholesaler for your store, and they deliver it and they give you a bill, and you're supposed to pay them within 30 or 45 days, or maybe if you pay them sooner, you can take a discount. And those are accounts payable, and those are short-term liabilities. Long-term liabilities, liabilities to be paid in more than 1 year. These are often to lenders, banks, that sort of thing, mortgage companies. And those are long-term liabilities. Those are typically paid to lenders or to to lenders. So anyhow, equity is the net worth of the company. It's the excess of assets over liabilities. We know that from algebra. If you have the equation assets equal liabilities plus owner's equity, and then you subtract liabilities from both sides, then you end up with the equation that assets minus liabilities equals owner's equity. That's just, simple algebra that you learned many years ago in school. May not remember, but remember it now. So that's another way of writing the accounting equation. And it's also expressed as the excess of assets over liabilities. That's owner's equity or the net worth of the company. And the statement of cash flows reconciles cash versus accrual accounting. Now, don't worry about accrual accounting too much yet, but it's another type of accounting method other than cash accounting. And an example, if I send a bill for $1,000 from my law firm to a client, under the accrual method, I would then book revenue of $1,000 and accounts receivable, because the client owes me the money, accounts receivable of $1,000. And accounts receivable are typically short-term assets. Okay, so those would be, I would hope that the client would pay me within a year. I've had some clients who haven't paid me within a year, but we've kept after them, and in almost every case we get paid. But if I'm on the cash method of accounting, which I am, and which many small businesses, particularly service type businesses like a law firm, if I'm on the cash method, when I send a bill for $1,000, I do nothing and don't set up the account receivable. Perhaps I have a list of collections for accounts receivable, but I'm not going to book the income until I actually receive it under the cash method of accounting. So when I send a bill, I do nothing. When the client gets the bill and then pays us, within whatever, 10, 20, 30 days, we get the check for $1,000, we deposit it in the bank, and at that point, we book the revenue of $1,000. Okay, that's the cash method versus the accrual method in a nutshell. Okay, so that's the end of the first learning objective. Now let's look at defining, explaining, and providing examples of current and non-current assets, current and non-current liabilities, equity, revenues, and expenses. So assets and liabilities are categorized into current and non-current based on when the item will be settled. So assets and liabilities that will be settled in 1 year or less are classified as current. Otherwise, the items are classified as non-current. And remember that I said that non-current is also known as long-term. They're synonyms. And I use long-term as much as I use non-current. Non-current just sounds funny to me. It's a little bit like in the law. We can have revocable and irrevocable. Because irrevocable sounds too much like revocable, a lot of times we'll pronounce it irrevocable. But in any event, just so I don't confuse people. Non-current or long-term, they're equally good in my class, although the book uses the term non-current. Assets are also categorized based on whether the asset has physical substance. So assets with physical substance are called tangible assets. Intangible assets lack physical substance. So what's an example of intangible assets? That could be trademarks, logos, software, licenses, leases, contracts, those sorts of things. Tangible assets could be, desks and chairs and computers and all that. The distinction between current and non-current assets and liabilities is important, but because it helps the financial statement users assess and understand the timing of transactions. Current assets minus current liabilities is called working capital. Working capital is often used as a measure of liquidity in a business. So current assets, short-term assets, right? Assets that you're going to collect on relatively quickly, cash, accounts receivable, inventory, minus current liabilities, accounts payable, other short-term debt. That's called working capital, current assets minus current liabilities. And it's a measure of liquidity in a business, and you may come to revisit that sooner than you think. So three broad categories of legal business structures are the sole proprietorship, the partnership, and the corporation, with each structure having advantages and disadvantages. And if you look at that list of advantages and disadvantages in your book, you'll see a lot of good information about the general considerations, certainly that our clients have in choice of entity when they're setting up a new business. So many times people will consult with an attorney when they're setting up a new business, and they'll say, hey, what type of entity should I be? Should I be a corporation? Should I be a partnership? Should I be an LLC? Can I operate this simply as a sole proprietorship? And what are the liability issues? What are the tax considerations? So learn those rules and be prepared to answer questions about those rules as far as limited liability, as far as single taxation or double taxation. Typically with a corporation, a regular corporation, you will get double taxation, in that the corporation is taxed on the income, and then distributions to the owner, called dividends, are taxed again. That's double taxation. Typically a partnership or an LLC that is using the default categorization as either a disregarded entity, if it's a one-member company LLC, or if it's a multi-member LLC, the partnership classification. Those are flow-through entities. And there is a special type of corporation called an S corporation that's a flow-through entity that has single taxation. But we'll talk about that when you take a tax class. So that probably won't be an issue during this semester. But just understand that the different types of business entities can have very different aspects with respect to liability and taxation. Typically, the owners of corporations have limited liability. The owners of limited liability companies typically have limited liability. And the limited partners in a limited partnership have limited liability. General partners and sole proprietors typically don't have limited liability. Their other assets are exposed to claims that are business related. So contract claims and tort claims will expose their assets to liability, to claims against their assets outside the business. Where if you have limited liability as an owner, then claims against the business are typically limited to the assets of the business and not your personal assets. Okay, so the accounting equation is assets equals liabilities plus owner equity, and there's a section on that. It's important to the study of accounting because it shows what the organization owns and the sources of or claims against those resources. Think about it like this. If you purchase a home for $200,000 and you have a $175,000 mortgage, then your equity in the home is $25,000. And typically you're going to have to come up with $25,000 at closing and maybe the closing costs too. But in any event, in that case, your asset, the home, is $200,000, and that equals liabilities, the $175,000 mortgage plus your equity of $25,000. So that's how things work from an accounting standpoint, and that's how they work in real life too when you buy a house. Owner's equity can be thought of as the net worth or the value of the business. There are many factors that influence equity, including net income or loss, investments by and distributions to owners, revenues, gains, losses, expenses, and comprehensive income. Now see figure 2.4 in your materials for a good graphical representation of the accounting equation. And that's updated for both current and non-current assets and liabilities, and a listing of all transactions that can affect owner's equity. Okay, so that's Unit 2.2. Now, Unit 2.3 that we're just going to skim, prepare an income statement, statement of owner's equity, balance sheet. Just browse this section for now. We'll come back to it in a few weeks. Note that there's a simple trial balance. A trial balance is a listing of all the accounts on the income statement and the balance sheet together. There are 10 financial statement elements. There's revenues, expenses, gains, losses. Then those are typically the income statement elements. Then there's assets, liabilities, equity, investment by owners, distribution to owners, and comprehensive income, and those are typically the balance sheet items. There are standard conventions for the order of preparing financial statements, and you'll see how your book organizes the look of financial statements, and that's a look you can learn and copy. And you should try to make your financial statements look like the examples in the book when you do them. That's the correct format for those types of financial statements, where you'll have current assets, then you'll have non-current assets, total assets, and then on the other side you'll have current liabilities, non-current liabilities, and owner's equity. And there's within those broad categories, there are other conventions as far as how you list the specific accounts. Financial ratios, which are used to calculate calculated using financial statement information, are often beneficial to aid in financial decision making. And if you watch the business news, sometimes you'll hear business analysts talking about financial ratios of certain companies and what that means to their profitability, their growth potential, and their financial stability. And these ratios allow for comparisons between businesses and determine trends between periods within the same business. So they can be used by lenders to evaluate whether or not we should make a loan to a business. They can be evaluated by investors as to whether or not we want to invest in the business. Now, one of the ratios that we use is the liquidity ratio. It assesses the firm's ability to convert assets into cash. So we have working capital, which is current assets minus current liabilities. That's a liquidity measure that measures the firm's abilities to meet current obligations. And then you have the current ratio, which is current assets divided by current liabilities. That's similar to working capital, but it allows for better comparisons between firms because they could be different sizes. You could have a firm with a lot more working capital than a smaller firm, but the working capital of the smaller firm could be greater in terms of its ratio of current assets to current liabilities, which might mean even though it's smaller that it has more liquidity proportionately. So we'll probably look at in one of our questions, we will take a look at the comprehensive example for Cheesy Chuck. So we won't construct the financial statement yet, but we'll probably have a question about it either in the homework or a quiz. So in any event, this is our treatment, our truncated treatment of Chapter 2. I will be posting additional lectures about Chapter 1 just to recap the quiz that you did that was due yesterday. I'll take a look at that and grade that and give you my thoughts about that in another video, and then do the same after we do the homework and the quiz for Chapter 2. So be on the lookout for the homework assignment and also the end of the week quiz for Chapter 2. And if you're finished with your reading in Chapter 3, and you need something to do, go ahead and start reading into Chapter 3. So feel free to contact me if you have any questions at any time, and also please consider subscribing to my YouTube channel so you don't miss any videos that are assigned, because sometimes in Wolf Den, when I do the due dates, things are available and then not available. And in any event, if you just link or have a way to get notice of additional videos when I post them in YouTube, you'll be ahead of the curve. So have a great day, and we will see you again soon. And by the way, I expect this Friday to be having office hours in Newberry, at the Kaufman Dining Hall between 9 o'clock and 11:30 in the morning. So if anybody's having problems with their homework or anything else, or questions about the class, feel free to stop by. I'll be the old guy, probably grading assignments with a cup of coffee in the corner. So anyhow, have a great day. Bye-bye.